If you're new to the channel, click the link below to download Blossom Social. You can follow my portfolio and trades live. It's completely free. See you there. Hey dudes and dudettes, it's time for our March update of our $116,000 TFSA dividend stock portfolio. In this video, we share our 17 holdings and which stocks we continue to buy during the global banking crisis. Let's do this. For those that are new to the channel, my wife and I do our finances together. We have 3 accounts through 2 brokerages for our TFSA, Scotia iTrade and Wealthsimple. As you can see in our Wealthika account, the month of March has been even rougher compared to the start of the year. We finished March down just under 1% and finished Q1 up only 4% after the blazing start to the year. The global banking crisis has been averted for now, in my opinion. I firmly believe this event has given us another opportunity to buy shares on a discount. For those that are curious, our top performing stock in Q1 was AQN, up 26%. Now for the update. Let's start with our one and only ETF in our TFSA, VFV, Vanguard's non-hedged S&P 500 index ETF. VFV still makes up a tiny 0.2% of our portfolio. We have an allocation target of 5% and haven't budged towards it yet. I feel there are better options for us in the market at present with the same amount of capital protection as this index ETF. VFV is up 3%, partially due to the CAD falling against the USD. I still see the index as overvalued at the current level. However, now I need to keep in mind the context of a devaluing Canadian dollar and the current state of interest rates. Next, TD Bank makes up 2.4% of our portfolio. The beginning of March saw the financial sector get hit hard with the global banking crisis. TD was under a lot of pressure as a 10% equity holder in Charles Schwab and had a deal to purchase First Horizon Bank, a regional bank in the US. Both those stocks had a substantial amount of market cap wiped out. However, I believe it was overdone when TD's price dropped much below fair value, and TD's market cap drop was substantially higher than the amount wiped out by First Horizons and Charles Schwab. Q1 earnings were also reported at the beginning of the month. They came in as expected. Reported earnings were down 58%. Adjusted earnings were actually up 10%. Some big items that impacted reported earnings besides the provisions for credit losses, which I might add are not guaranteed to be used, were the Canada Recovery Dividend and impact from increase in the Canadian federal tax rate for fiscal 2022 of $585 million, and stand for the litigation settlement of $1.6 billion. As I mentioned in February, I was looking to add to our position in the $83 to $79 ranges. Because I felt the market overreacted, we added 21.07 shares at an average cost of $81.58. This added $80.92 to our forward annual dividend income at a yield of 4.7%. I have built out about a third of my position and will look to tranche in again around the $76 mark. If the recovery is quick, I'll have to readjust my buy order. Next, CANOE EIT Income Fund makes up 2.5% of our portfolio. It is underperforming the market so far this year, down 6.2% after the first quarter. With a portfolio weighting of 22% financials and 19% energy, it's no wonder it has been hit hard. Next up is FIERA Capital. It represents 3.5% of our portfolio. FIERA is now down 12% on the year after being up 7% in January and flat in February. Q4 earnings were released last month. They were bad, as I mentioned. I maintain my sell position on FIERA. I'm waiting for some positive news to sell on. In the meantime, I'm using the dividends to build out other positions. Next is Algonquin Power and Utilities Corp. This is our renewable energy play in the utilities sector. This makes up 4.3% of our portfolio. Algonquin is up 32% from its lows in December. It is now up 11% in March alone. Q4 and year-end results were announced in the middle of the month. Here are my takeaways. Revenue was up 22%. However, adjusted net earnings were down 3% to 69 cents a share. The Kentucky Power acquisition is still on the table with a new application filed with the government for approval. The outlook for 2023 remains the same with a 55 cent to 61 cent net earnings per share, which is a 12 to 20% reduction from 2022. And lastly, what I was looking for most, interest costs were up almost $70 million. In January, they entered into an interest rate cap agreement on $390 million worth of non-fixed interest debt. This should provide some relief now as 89% of debt is now fixed. Before we continue, I want to do 2 things. First, to tell you guys how awesome you are. You really keep me motivated to make videos. And secondly, to tell you guys how awesome you are for smashing the like button and subscribing to the channel. It makes all the difference in being able to reach as many dividend growth investors as possible. Now for the bigger half of the portfolio. Next, we have MANULIFE Financial Corporation at 4.7% of our portfolio. We have a 5% target weighting on this position. MFC is down 9% on the month, caught up in the global banking crisis. Last month's earnings and dividend increase are long forgotten. It just shows you how fickle the market is right now. I am happy to hold this with its 5-year price and dividend CAGR making for a TSX average return. This is now almost bond-like in the portfolio. Next up, we have BCE Inc. at 5.5% of our portfolio. We have a target allocation of 6%, though it will hover slightly less to allow TELUS to be the bigger position. It finished Q1 flat. It reported earnings in February, and they were okay. You can check out February's portfolio update to hear my thoughts on the report. BCE has a very modest 1.5% 5-year CAGR on its share price to go along with my 7% dividend. This makes for another TSX average return, another bond-like stock in my portfolio. We bought 2.05 shares at an average price of $59.75. That added $7.92 to our forward annual dividend income at a yield of 6.5%. Next, we have TELUS Corporation at 5.6% of our portfolio. After the hot start to the year, it finished Q1 relatively flat. TELUS has a 5-year CAGR on its stock price of 3.1%, majorly down after this market pullback again. I expect this to get back to being above its dividend increases of around 10% a year. We bought a lot of shares in February. This month, we bought 7.29 shares at an average price of $27.17. That added $10.24 to our forward annual dividend income at a yield of 5.2%. We have been averaging up a lot on TELUS. We are okay with this because we sold shares at a price of $28.84 back in September of 2022. Next is our OG utility, FORTIS. It represents 6.2% of our portfolio after the recent run-up in share price of 7.5%. The month was more turbulent than usual for a low beta stock like this. Its 5-year CAGR on its stock price of 5% is still much below its historical average. Last month, we added to our position slightly. This month, we dripped 1 share at a price of $53.58. This added $2.26 to our forward annual dividend income at a yield of 4.2%. Next, we have our first midstream pipeline, PEMBINA Pipeline Corp. It also represents 6.2% of our portfolio. PEMBINA finished Q1 down 3%. Last month, it reported Q4 earnings. They were in line with expectations. This hasn't dipped to near our book value in quite some time. In these market conditions, we will add to this position below $40. Next up is our OG pipeline, ENBRIDGE, at 6.5% of our portfolio. It is also down 3% after Q1. It was relatively flat most of March though. Q4 results were released last month, as I commented on last month. We haven't bought any shares yet, but we'll look to do so if this dips below $50 again. We're looking to bring this in line with our TRP weighting. ENBRIDGE has a 4.8% 5-year CAGR on its share price to go along with a lovely 7.6% yield, making for an attractive safe return for us. Next up, we have SMARTCENTRES Real Estate Investment Trust at 7% of our portfolio. This REIT is another staple in our turf portfolio and is down 2% after Q1. It was trading as much as 8% down in the month. Real estate was hit hard in part because of the global banking crisis. It'll be interesting to see how the next few quarters go, especially if we start to see some softness in the economy. We'll continue to add at or below our cost basis. We bought 5.54 more shares this month at an average price of $26.14, adding $10.28 to our forward annual dividend income at a yield of 7.1%. Next, we have TC Energy Corp at 7.3% of our portfolio as our last pipeline play in the energy sector. It is down 1% on the year, the best performing of the 3 pipelines we own. At one point in March, it dropped below $51, a price we hadn't seen since the early COVID days. Q4 earnings that I spoke about last month were not good. We did have a good buying opportunity, so we added to our position despite being overweight. We bought 6 shares at a price of $52.92. That added $22.32 to our annual dividend income at a yield of 7%. Next up, we have our mid-cap utility, Capital Power Corp, at 8% of our portfolio. This has been pulling back and finished Q1 down 10%. It made a new 52-week low in March. This has been a steady performer with a 12% CAGR on its stock price over the last 5 years and healthy dividend increases averaging 6.9%. we really want to buy back our full position after selling so much last September. We bought only 3 shares at an average price of $41.14. That added $6.96 to our forward annual dividend income at a yield of 5.6%. Yes, this continues to be much above our average cost basis, but I'm okay with that given the size of the purchases and the fact that we sold $3,000 worth at over $50 a share. Averaging up is not always a bad thing when the size of my portfolio increases. Now, our third largest position is First National Financial at 8.2% of our portfolio. It finished Q1 up 2%. Earnings last month were better than I had anticipated. Also, for 2022, the common share payout ratio was 73%, which is healthy. We'll look to continue to add to this position when the price is right. I was hoping the global banking crisis would have provided a buying opportunity. However, it didn't provide anything out of the normal price fluctuation. As a low-volume stock, prices can fluctuate more abruptly than others in our portfolio. It's the risk we take to get a 7.7% 5-year CAGR on its stock price, plus a very generous dividend. Second to last, at 9.5% of our portfolio, is Bank of Nova Scotia. This is our second largest holding. Still, it finished Q1 up 4.5%. Not bad considering it was down substantially during the banking turmoil. Q1 earnings were reported last month, but it was the global banking crisis that impacted the share price this month more than anything. I'm still waiting for BNS to bounce back so we can trim this down. We are actively growing our TD holding again, and it should outweigh BNS substantially. We bought 1 share at $65.81. This added $4.12 to our forward annual dividend income at a yield of 6.3%. We just couldn't resist a nibble at this price level. And lastly, our largest holding remains RIOCAN Real Estate Investment Trust. It is 12.5% of our portfolio, down from 13.7% last month. It finished Q1 down 4%. At one point, it was down 9% in March alone. Again, the global banking crisis was causing all kinds of havoc on the REIT market. I am very confident in management that they'll keep growing FFO and NAV in these ugly market conditions. We were able to drip 2 shares at a price of $21.66 at the beginning of the month. We have a very low cost basis, so it doesn't bother me to leave drip on. This added $2.16 to our forward annual dividend income at a yield of 5%. Because we are still overweight, I then sold 4 shares at $21.80, decreasing our forward annual dividend income by $4.32. I'll keep the drip on in the meantime because I'm weird like that with our iTrade account. So there you have it, all 17 holdings we own and what purchases we made in the absolutely crazy month of March. We deployed a total of $2,700.89, adding $151.47 to our forward annual dividend income this month at an average yield of 5.6%. That's after divesting a few shares too. If you watched our March income update, you'll notice that we spent a lot more than we earned this month yet again. We have almost $57,000 in TFSA contribution room we're trying to deploy on undervalued stocks. Thank you so much for watching and helping the channel out by smashing that like and subscribe button. Until next time, I'm Mr. Financial.